So today we're going to talk about a qualified mortgage versus a non-qualified mortgage. Qualified mortgage just really means that the loan conforms to Fannie Mae, Freddie Mac, VA, FHA, or USDA guidelines. It's a typical loan that you find in the marketplace. A non-QM loan means that it's more of a private funding. Money can come from insurance companies, hedge funds, or other investors. They don't quite play by the same rules as a qualified mortgage. So what really is the big deal between the two? Well, a qualified mortgage is a mortgage that conforms to what the loan requirements are so that a lender, once they close the loan, they can turn around and sell that loan. If the lender can't sell it to an investor, more often than not, Fannie Mae or Freddie Mac will purchase the loan from the lender. And why is this important? Because most lenders get their money from commercial banks as a short-term loan. So when you apply for a mortgage and the lender wires the money to fund your loan, they have a very small window of time to be able to package up that loan and get it sold, pay off the short-term loan that they got from the commercial bank, and then any additional money they made is how they make their profit. Okay, lenders are not in the business of loaning money and holding your loan for the long term. That's called servicing, and that's conducted by a completely different set of rules and by different institutions. So getting back to QM and non-QM, with a QM loan, it's very easy to sell that loan on the market once you close it because it follows all of the traditional guidelines. And if they can't find that buyer, they're going to sell it to Fannie Freddie. But if it's non-QM, it means that it doesn't fit those requirements, but it's still an option for people to be able to get housing. Let me explain. You get a self-employed buyer that has a lot of write-offs. And because of all the write-offs, when we receive the tax returns, it doesn't show that they have a lot of income, taxable income, which is what we have to use on a qualified mortgage to be able to get them a regular traditional loan. But what you can do is if they have a large amount of deposits in their bank statements every month, we can collect either 12 or 24 months business bank statements. We show those deposits and then they average out the deposits. So let's say it's 12 months. They're going to take all the deposits over 12 months. They're going to divide it by 12. And then they're going to subtract any fixed expenses, like maybe there's an office lease that they pay every month, or maybe there's specific other expenses that they pay to run their business. They're going to deduct that from that number. Whatever is left, that's their income. So let's say they make $10,000 a month of deposits. They have $1,000 worth of fixed expenses. In that case, we're going to use on a non-QM loan, $9,000 is going to be their monthly income. And that $9,000 is what we're going to use to qualify on a mortgage. Where if we have their tax returns, it might only show that they're making $2,000 a month because they have all these write-offs that they're allowed to take. So that's the difference between QM and non-QM. So some people ask me, well, if it's easier, why don't people just go with non-QM? Non-QM loans typically have higher interest rates than qualified mortgages. And the reason why is that these loans aren't necessarily going to be sold on the bond market. A lot of these loans are going to be held, and because they're held and they can't turn around and lend that money again, they're going to charge a higher rate of interest. There is one other one, and that's basically private money. And private money, or hard money as they call it, can be very, very expensive. So non-QM is kind of in between. It's in between the qualified mortgage and hard money. So the rates are higher than traditional, but not quite as high as hard money. They're somewhere in the middle. And what's also great about those loans is that a lot of times they offer things like interest only. They offer 40-year terms. They may not require reserves where traditional loans do. They can use bank statements for income instead of tax returns and W-2s and things of that nature. So there's a lot more flexibility. And more often than not, those loans can close very quickly.